The Federal Reserve has several tools to conduct their monetary policy. The first one we'll talk about is the interest on excess reserves, and that is the main tool the Fed will use. So the strategy is to influence the federal fund rate being the interest rate that commercial banks charge each other when they borrow money from each other. So what are reserves? Each major commercial bank holds reserve in an account at their regional Federal Reserve Bank. So, for instance, a major Houston bank will have an account at the Dallas Federal Reserve Bank where they will hold their reserves. There are two types of reserve. The first is what we call required reserve because that is the amount that the banks have to keep to meet the Federal Reserve's requirement. And that requirement is to ensure that banks are sound and that customers' deposits are safe. In addition to the required reserve, banks can hold excess reserve, and they do so for unexpected needs or to have extra cash on hand and so on. Here is a very basic bank balance sheet. A balance sheet is an accounting document that shows assets and liability for a business. We use the balance sheet here to help us show how the assets and the required reserve and excess reserves and the loans that the banks are able to make, that is determined. So, for instance, assets are what the bank owns, and liabilities are what the banks owe to their customers or to their owners or their creditors. So, for instance, customer deposits, that is a liability for the bank. When you put money in your bank account, the money does not belong to the bank. It still belongs to you. So the bank owes that money to you. But on the other side, the banks own the loans that they make to their customers and their reserves. So for every dollar that is deposited in the bank, it will hold a certain percentage in required reserve, as is mandated by the Federal Reserve, and it can hold a portion of it in excess reserve if it deems necessary, and the remainder can be turned into loans and other investment. So the banks can use their excess reserve to lend to each other. So let's say Bank 1 has a little bit extra reserve, excess reserve on hand, and Bank 2 needs money. They need extra money to cover their required reserve or for other purposes. They can borrow overnight from other banks, and the next day they would return that amount of money plus some interest. That interest rate that they are paying is what is called the federal fund rate. So the main tool that the Fed will use to influence the interest rate is the interest that they will pay on excess reserve. The Fed actually pays interest on both types of reserve to the banks. They will pay interest on required reserve, and that is just to compensate the banks for keeping their money idle because they're not able to earn interest or make any money from required reserve. So the Fed gives them some interest on those required reserve. And the Fed also pays the bank to hold these excess reserves. And they can use this to encourage or discourage banks from lending to each other and to the public. how this works. Well, if the interest that the Fed will pay on excess reserve is greater than the federal fund rate, the banks will have the incentive to lend less and they will keep more reserves. As a result, there will be less funds available for lending in the banking system and the federal fund rate will increase. Let's go through an example. Bank 1 has some excess reserve and it can earn money from the Fed because the Fed will pay 4% on these excess reserves. Or it can lend money to Sun Bank and earn the federal fund rate, which is 3%. What do you think US Bank 1 should do? Well, it will earn more money by keeping their reserves and not lending. And what does that mean for Sun Bank? Well, it means if they cannot borrow the money at 3%, they're likely to be willing to pay more than 3%, and that tends to push the federal fund rate upward. So in this case, US Bank would keep their reserves, earn their 4%, and Sun Bank would be likely in the near future to want to pay more than 3% if they really need the money. So, if the Federal Reserve wants to increase interest rate in the economy, they would raise the interest rate on excess reserves. That way, banks are lending less to each other. There's less money available for lending, which means that other banks are going to be willing to pay more to get funding, and that will push the federal fund rate higher. And it would also, as a result, push other interest rate higher. If it becomes more expensive for banks to borrow, then it also becomes more expensive for their customers to borrow money from them. And that's how the Fed plays or influences the interest rate. If they were to lower the interest rate on excess reserves, then there would be more money available for lending from banks. Federal fund rate would likely decrease and other interest rate would also decrease.